Ladies and gentlemen, good day and welcome to the Q1 FY23 earnings conference call of Jindal Steel and Power Limited, hosted by Motilal Oswal Financial Services Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then zero on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vishal Chandak from Motilal Oswal Financial Services. Thank you, and over to you, sir.
Thank you very much, Rutuja. Good evening, ladies and gentlemen, and welcome to the first quarter FY23 earnings call of Jindal Steel and Power. I would like to thank the management of JSPL for giving us the opportunity to host the call for this quarter. We have with us the senior management from JSPL comprising Mr. V.R. Sharma, the Managing Director, Mr. Ram Kumar Ramaswamy, the CFO, and Mr. Nishant Banwal, heading the IR. So I would hand over the floor to Mr. Nishant for his remarks. Over to you, sir.
Thanks, Vishal. Thanks, Rutuja. Good day, everyone. We are pleased to welcome you all to this conference call to discuss our first quarter FY23 financial results. First of all, I'd like to apologize for the delay. Since our results, there was a delay in publishing our results. We thought it's better that we give a few minutes before starting the call so that everybody can go through it. This time, to be able to take more question and answers and give ample time for it, we decided to dive straight into the financial commentary, which will be given by our CFO, Mr. Ram Kumar Ramaswamy. And thereafter, we'll take the Q&A. And the entire management, including our MD, Mr. V.R. Sharma, and our CFO, Mr. Ram Kumar Ramaswamy, are there for that. So over to our CFO.
Thank you, Nishant. Good day and good evening, everyone. I would like to take you through the details of the financial performance of JSP for the quarter ended 30th June. Let's start with the production volumes. Our production during the quarter was 1.99 million tons. This was lower over the previous quarter by around 6%. The primary drivers for this was one, at our Raigarh plant, there was a maintenance shutdown in our plate mill. And number two, at our Angul plant, we had a lower DRI production due to thermal coal availability. I'll talk about sales. Our sales volume during the quarter was 1.74 million tons as steel sales. This was lower by around 16% over the previous quarter. As you know, this quarter we had challenging market conditions. We started off with a soft April, and then during May we had the imposition of the export duty. Both our domestic and export volumes have been impacted during the quarter. Our domestic volumes were lower by around 12%, and our export volumes were lower by around 28% during the quarter. In terms of realization, our realizations were higher by around 12% over the previous quarter, primarily driven by healthy realizations in April and May. After the imposition of the export duty, we've seen a significant softening of both our domestic and export realizations in June, and we see that continuing in July as well. We see a softening to the extent of 15-16% in terms of our realizations in June and July. In terms of our costs have gone up by around 10%, primarily driven by a coking coal cost increase of around 33% and a thermal coal cost increase of around 27%. As many of you would know, we are seeing a softening of prices currently for all of these, and we expect the benefit of this to flow through in the subsequent quarters. I will now quickly move on to our gross total income. Our gross total income during the quarter was 14,561 crores. This was 7%. This declined by around 7% over the previous quarter for the reasons that I just detailed in terms of a volume decline offset by higher realization. The GST that we collected during the quarter was around 1,692 crores, and our net income was 12,869 crores. Let me quickly move on to EBITDA or adjusted EBITDA. Our adjusted EBITDA during the quarter was 2,865 crores. This is an 8% increase over the last quarter. Again, the primary drivers for this, as I mentioned, was driven by healthy realization and offset by lower volumes and increased costs. Yeah. So our EBITDA was 2,865 crores, adjusted EBITDA. In terms of profit after tax, again, our adjusted profit after tax is 1,626 crores. This is a 28% growth over the last quarter. Again, for reasons that I detailed earlier. Yeah. So 1,626 crores is our adjusted PAT. In terms of just a quick overview of our consolidated numbers and our performance of subsidiaries, I think we had a very, very good performance during this quarter of the subsidiaries. Our Mozambique, South African, and Australian businesses had positive EBITDA after a very long time, maybe the first time. Our Mozambique subsidiary had a EBITDA of around 334 crores. Our South African subsidiary had a EBITDA of 84 crores, and our Australian subsidiary turned positive at 24 crore EBITDA. Let me also quickly give an overview in terms of our debt position. Our standalone net debt is 7,413 crores, which is at a 0.54 times EBITDA. Again, very, very healthy times. This is close to a 1,000 crore reduction over last quarter, primarily driven by long-term loan repayments and a lower short-term debt as well. A quick update on our credit rating. Our credit rating stands unchanged at AA minus, and with strong financial performances, we expect that there would be improvements in credit rating. This is a quick summary of our financial and operational performance. With this, I hand it over to Nishan.
Thank you, sir. Now we'll dive straight into the Q&A. As always, would request all of you to kindly ask more strategic questions. We at IR team, including myself, Rajesh, and Gaurav, are always there to give you the data points. With that, I'd probably hand over to the operator.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Amit Dixit from Edelweiss. Please go ahead.
Yeah, good evening, everyone, and thanks for the opportunity. Congratulations for good performance. I have two questions. The first one is essentially on your maintenance plans for this quarter. So, what kind of maintenance plans you have for this quarter, both at Angul and Tiger, and in particularly, thermal coal availability and prices both are high. So, can we see some kind of intermittent shutdown at your DRI plant? So that is the first question I have.
Yeah, thank you very much. I'm V.R. Sharma, Managing Director. So first of all, we are not taking any long maintenance shutdown. So rather we are going for the intermittent shutdowns whenever it is required. So of course there is a shortage of thermal coal, but we are now importing thermal coal, and hopefully in next 1 week or 10 days time the situation will be normalized. So our intention is not to reduce the production. We have a target of 8.2, 8.4 million ton in this particular financial year, and our aim is same. We will be producing more than 8.2 million ton in the current financial year. No longer shutdowns, but in case there is some breakdown which is unavoidable, like it has happened about 2 months back, so that is the issue. Sometimes it happens, but otherwise there is no planned shutdown till next year, 31st March. Hope I have answered you.
Yes, sir. That was a very elaborate answer. The second one is essentially on the coking coal price and thermal coal price movement over next quarter, QOQ. If you can give in dollar and rupee terms, that would be great.
Yes, okay. It's very difficult to predict today's market because the world is melting down. We do not know where the world will settle. So the first and foremost issue is the Russian and Ukrainian war. The moment the Russian and Ukrainian war that comes to an end or it recedes, then only the world will stabilize, otherwise not. Because you must be seeing nowadays most of the European countries, they have already started rationing the usage of gas, and they want to store the gas for the winter season. Because Russia has total gas from 100% supplies to 40% supplies only. So 60% is reduction in the overall supplies of the gas. And this is the reason there is a overall chaos and shortage of energy worldwide. Let us see. Mr. Joe Biden is visiting Saudi Arabia. I think they will reach to some conclusion, either to pump out more oil or more gas. This may give a respite to the world. But today, the whole world, entire world is uncertain. As far as the coking coal prices and the steam coal prices are, today, surprisingly, the coking coal prices are lower than the steam coal. So, in international market, landed in Europe. Reason being because European power plants, the thermal power plants, they are reignited, restarted, refired. So people are using more coal than using gas. The gas-based power plants are almost shut, and wherever there is no thermal power plant, there only the people are using the gas-based power plant. So the demand for the thermal coal will continue as it is. There won't be any respite till Russia and Ukraine, they settle their scores. And if they settle their business, in terms of ending the war, then only situation will be comfortable. But we feel in the quarter which is now going on, quarter 2, the things should remain somewhere about approximately. I cannot vouch for it, but approximately I feel $230 to $240 level of coking coal, and a similar about $200 to $210 on C&F basis the steam coal into India. But yes, of course, the steam coal prices in Europe will be more than $300, and also in many other parts of the country. So, hope it is clear.
Yes, sir. The price level is of course clear, but I was looking for the movement from JSP's perspective on your cost. What kind of cost movement you expect in
cost is reducing now because earlier the cost was, the coking coal was at a level of about $500, $520. Now it has come down to $240. So definitely the input cost has reduced, and similarly the input cost for the iron ore has also reduced. Therefore, yesterday the NMDC has reduced another 1,000 rupees. International also, the iron ore prices have come down to $99, $98 per ton day for yesterday. And I think that is a good sign in terms of input cost reduction. But yes, of course, there is always some a time lag in between the new material comes in the pipeline. So now at the moment, yes, the old material is in the pipeline. That will last about 5 to 6 weeks. But finally, the results of the low input cost will definitely come within this quarter, maybe second half of this quarter. After say 15th of August, we can see that the new prices or the input cost on the new material, that will be applicable.
Okay, sir. Okay. Thanks and all the best.
Thank you.
Thank you. The next question is from the line of Sumangal Nevatia from Kotak Securities. Please go ahead.
Yeah, good evening and thank you for the opportunity. My first question, sir, is on the net debt movement. So this quarter our debt has reduced by around 1,100 odd crores against our cash profits of around 2,000 odd crores, and also the JPL equity infusion of around 3,000 odd crores. Is it possible to walk us through the net debt movement during this quarter?
Yeah, thank you for that question. So as I said, the net debt for the quarter was 7,413 crores. We had a structured long-term repayment of around 400 crores, and the rest of it was more reduction in our short-term debt. We continue to hold cash in our balance sheet of roughly around 3,000 plus crores. and we will be, on an ongoing basis evaluating options to repay, options to prepay, and options to hold cash.
Sir, I'm looking for some specific details as to what was the working capital build-up during the quarter, and CapEx, and also what was the tax outgo with respect to the GPL divestment?
Okay. On the working capital build-up, I think we did have a working capital build-up during the quarter, primarily because of the export duty being imposed, and therefore there was a softening in terms of customer demand. So we did have a working capital build-up. Maybe I don't have the exact numbers, but it will be safe to say that it will be upwards of around 2,500 to 3,000 crores. Yeah, I think that was the kind of working capital build-up that we had. Sorry, what was your second question?
The CapEx and the tax outgo on the JPL divestment.
This is Nishant here. So, Sumangal, as far as the tax outgo on the JPL divestment is considered, that's mostly an yearly item because this is a divestment. We've received 3,015 crores of cash pursuant to the divestment. The entire tax would be on the yearly basis. So let's see how it pans out. Because as you all know, yes, there would be certain capital gain to it, which can be offset by some capital losses or any other business losses. So that is something that we get to know by the end of the year. Yes. Hope that answers your question.
All right. I have a second question. So with respect to price movements, we've seen a very sharp correction in prices, and also exports are now getting attracted 15% duty. Is it possible to guide how are we seeing the LSR for Q2 and coming months?
So I think, as you said, the market is quite volatile and challenging. Yeah. Much as we would like to provide some guidance, I think we would like to avoid providing any forward-looking guidance on this. Whatever is the market prices that are going to be there, we will try and make sure that we are able to sell our products at those prices or at slightly higher prices to reflect the premium that we have. But currently, we don't want to provide any forward-looking guidance on our realization.
Understood. Got it. Thanks and all the best.
Thanks.
Thank you. The next question is from the line of Rahul Jain from Systematics. Please go ahead.
Yeah, hi. Thanks for taking my question. Sir, on the raw material side, so how well are we integrated right now on our coking coal requirements, and how is it likely in the next, say, 1 or 2 years?
Yeah, thank you. So raw material side, we are very much comfortable, and we are not foreseeing any problem. We have adequate quantity in pipeline as far as the coking coal is concerned, or the PCI coal is concerned, and also the other point is iron ore is not in short supply. As you know that Government of India has banned, not banned, I would say, has imposed very heavy export duty on iron ore and pellets. So there is a flexibility now, and the iron ore and pellets are available in abundance. So there is no shortage of minerals in the country as of today. So we are thankful to Government of India for imposing such kind of duties so that raw materials are made available. Therefore, yesterday, Mr. Amit Shah, he also gave the interview to Economic Times and other financial magazines that our aim is that raw materials should be preserved, conserved, reserved for the local industry. I think that is a very good statement, and we are not finding any difficulty. Coking coal is also in abundance available, and our own mines, that is in South Africa, Australia, and Mozambique, they are working very well. At the moment, the coking coal dependence on outside, I would say, is about 40 or 42%, but 58% we are on coal. There's no shortage of material. Is okay?
Right. And so on iron ore, what is the number like now? Is the mine that you acquired, is it ramped up and things like that?
The mine, what we have now, what we won in the bid last time, that is Kasia mine, it is working, and we are producing about 500,000 tons per month. And we are also buying under long-term agreement, long-term lifting agreement, LTF, that is Odisha Mineral Corporation, OMC, and also from some of the private and merchant miners. So it's a good time. The raw material cost has come down. It's a good situation today, I would say.
Right. And sir, on the export duty, you have any comment? How long it will last, and what is the motivation behind adding this kind of duty?
You see, we are with the government. We don't have any problem in this particular issue. Reason being because each government takes decision looking to very macro and microeconomics. So I think the government must have thought twice to before imposing this particular duty. And there is no problem. We are today we are seeing that the selling price has come down. But we also found in due course of time the input costs are also receding, and that has given us a relief. As far as the demand is concerned, yes, there is during monsoon season the construction activities they go down and the demand comes down, and so is the demand in the world market. So I think internationally the world has to stabilize first. We in India we are self-reliant in steel making, and whatever quantity our country needs, that we can supply them. Initially we were thinking that the prices are coming down, but finally when we observed that the selling prices vis-a-vis input cost, the ratio is maintained accordingly, and the input cost has also come down. So we are also thankful to NMDC for declaring 1,000 rupees price reduction day for yesterday. So it's all good sign. Things are good, and when our government feels that the exports to be opened, we'll welcome that move also. And at that time,
we'll put number will remain in this high 20s, or you will bring down further. How is it looking forward?
Sorry.
Your export share of total sale will remain high in the high 20s, or you want to bring it down depending on market?
No, we will maintain the share. We'll maintain our share more than 20% of exports out of the total production.
Right. Thank you so much. Very helpful.
Okay.
Thank you. The next question is from the line of Pallav Agarwal from Antique Stock Broking. Please go ahead.
Yeah, good afternoon. So I had a question on the recent, reports of price hikes being taken in rebar. So could you just confirm whether these are true, and what is the actual quantum of price hikes that were taken?
You see, I think the primary steel mills have not increased the prices. Primary steel mills are playing in the band of 1,000 rupees, 1,500 rupees here and there. But yes, price hike we have seen in the secondary steel market. Reason being, this is what I observed. There are two reasons. One is the scrap prices all of a sudden in 15-20 days time moved from $380 C&F to $460-470 C&F in India. So I think that was an impact at that time. The other is many of the sponge iron plants, they were closed or they were not functioning properly because of shortage of coal. So that was the major reason. But I think major mills, primary mills in the country, their price band has been in the range of 1,500 to 2,000 rupees maximum here and there. But yes, you're right. Secondary steel, the induction furnaces people, their price, if you see, that has gone up by 7,000 to 8,000 rupees per ton as per the media reports. We do not know the actual fact, but this also we heard from the newspapers that 8,000 rupees price hike was taken by them, maybe because the delta was too big, and now they have recovered it. Okay.
Sure, sir. So just another question on, we do export some higher grade plates, etc. So I'm assuming some of this goes to Europe as well. So when are these quotas going to open again, or to some sense?
Quota is already open. There is no quota existing now. Europe is starving for material. They want any quantity, any numbers, whosoever supply them. So, but the international prices are also under pressure with 15% export duty, there are certain customers for the value-added grade, they still prefer to buy from India, and those material are also not impacting the Indian economy or the Indian customer base because these are the specialty materials. And as far as the common man's requirement in the country is, I think, rebars, wire rods for the MSMEs, and also the corrugated, galvanized, corrugated and sheets or the color-coated sheets for the roofing. I think these three items are not being exported by anybody, as far as my knowledge is concerned. But the specialty products people are exporting, and some of the customers are paying for that. So that is an impact.
Okay. Yeah, thank you.
Thank you. The next question is from the line of Rajesh Majumdar from B&K Securities. Please go ahead. Mr. Rajesh Majumdar, please go ahead with the question.
Am I audible?
Yes, you are.
Yeah. Thanks for taking my call, sir. So I had a question on the rebar prices as well. So Chinese rebar prices have come to a new low, a 1.5-year low this week. And our domestic rebar prices are still at a significant premium of the Chinese prices. So given the fact that coking coal prices have fallen now and the demand is going to be seasonally weak, do we expect the rebar prices to come up from these levels? In which case also our spreads will still be reasonably good.
You see, India was never importing rebars in the country. But yes, we are not insulated from the international scenario. Whenever the rebar prices go down, that means immediately the iron ore and coking coal prices will also go down. I mean, that is a sort of indirect index. The other is whenever the rebar prices or the commodity prices they go down, that means the scrap prices will also go down. So there is a cumulative factor of scrap, iron ore, coal, coking coal, all these commodities put together, they decide the prices. But rebar prices in China, the reduction in the rebar price in China is not because of anything else, but because of the poor demand there. So you might have seen financially they are also struggling today, and many of the rural areas, banks, they are in trouble. So the overall construction activities in China are a little down, or I would say the sentiments are down. This is what, as per my knowledge. But in India, the things have changed because here the customers are quite bullish, and we are seeing last 10-15 days time there is a good demand coming from the market because earlier the people they were not buying and they exhausted their stocks. Now the traders have come back in the market; they want to buy more material. So, but one thing is for sure: if the input costs they go down, then definitely the prices will be corrected accordingly. Okay.
Right. So basically, the spread will be maintained after that.
Yeah, because first of all, the entire world is one. Our first aim is if somebody gives an authority today, or somebody says that what is the one thing you want to do. So the first one thing what I will do, if it is in my hands, I will ask Russia and Ukraine to stop this war. Anybody on the earth, if he can do something in concluding the deals in between these two countries, I think whether it is stock market, bond market, rate of inflation, in next 2 to 3 months' time, everything will be settled. It is more a geopolitical issues today in the world. The entire Europe or the Western world, including America, they are supporting Ukraine. They are giving them all sorts of help in terms of arms and ammunition. And Russia is bent upon in asking them to surrender. So this is a big tussle. Who is going to win? But I believe in Mr. Modi. He said that in war nobody wins. So I think in this war, in between the two countries, neither they will win and nor the entire world will win. The whole world has lost trillions of dollars. So let us pray to God that a good sense prevails in between these two people, Mr. Putin and Zelensky, and they stop this war. The moment the war is stopped, the entire world will come up like a flower once again in the next 3 to 4 months.
And so my last question is that how long will it take for the current inventory situation in the system to normalize? Let's see, assume that let's see the 50% drop in the export.
Sorry to interrupt, but Mr. Majumdar, there is a lot of disturbance from your background.
Yeah, am I audible now?
Yes.
Yes, please. Yes, Mr. Majumdar, please. What was your question? Sorry.
My last question is that how long do you think it will take for the inventory in the system to get cleared, assuming that the export tax is willing at the current demand rate? Because we see the halving of the exports in June. So if we assume that the export taxes are there for some more time, how many months will it take for the inventories in the system to normalize?
You see, the inventory, we do not manufacture anything to keep the inventory. Actually, stock and sale is not our business. And we don't produce anything other than the rebars in anticipation. So all of our products are tailor-made, and whenever we get the order, we produce. Otherwise, we don't produce. We are not in the commodity business. Neither we produce hot-rolled coil nor galvanized coils, color-coated coils. We are not in that business. Our business is, if we get order, we produce. If we don't get order, then we will not produce. But fortunately, our order book is good. We are booked for next 45 days without any problem. And every day we are booking orders, and we are getting good orders. So thanks to domestic plate consuming industry, and there's a shortage of plates today in the country. So we don't need to export plates today because there is a shortage. Some of the major steel mills, they are gone for shutdown or breakdown. So I would say JSPL stands good chance to cater that market. So there are no issues. So we will maintain our volume around 2 million ton per quarter, 2.1 million ton per quarter, and reaching to a level of about 8.2 million, maybe 8.4 million ton by the end of the year. We will maintain it, and we will sell also. There is no problem. With 14,500 crores of sales turnover in the first quarter, we'll maintain the numbers. So that last year we did about 56,000 crores of sales turnover, and this year also we'll be touching more than 55,000 crores. So there are no issues. So we have made our plan accordingly. We have entered and moved into more and more value-added grade steel, where we get higher margins and where the competition is very low. So our team, research and development team, our production team, they are already on that job. So I'm not foreseeing any problem. Okay.
Thank you, sir. Thank you.
Thank you. The next question is from the line of Indrajit Agarwal from CLSA. Please go ahead.
Hi, good evening. Thank you for the opportunity. Two questions. First, given that we are in volatile times, so is there any change in our capex intensity or project timelines, or we stick to our capex plan? And with that vein, what has been the capex in first quarter, and what could we envisage for the year as a whole?
Very good question. First of all, I'll tell you, there is no volatile time. A volatile time is when you produce something which cannot be sold. The volatility in terms of prices going down one-sidedly is not volatile, because prices are not going up. Like, for example, the coking coal prices, if you see, it has gone up to $670, came down to $550, came down to $380, and then again went up to $520. That was volatility. But today, what we are seeing, if you see the graph and the index also, for the last 3 weeks, continuously the coking coal prices are falling, and continuously the iron ore prices are falling. So I would say it's not volatile situation, it is a downsliding. And that is good for reduction in the input costs, and that is good for the industry as a whole, and good for the customers also. So, but industry is maintaining the margins, so we are. So we are also maintaining our margins. I think there should not be any pressure on the margins, and there should not be any the quantity reductions. So this is one. We'll be maintaining a good cash flow in times to come also. And as you have seen the results, we have done a wonderful job during this phase also. And with the kind of PAT of 1,626 crores that we have generated, it itself speaks that company is doing extremely well. And the gross margins are somewhere about 19%. So that is EBITDA margin. So that is also a good number as far as the company is concerned. I think I'm very much hopeful that we'll be in a position to maintain these numbers throughout the year. The next question was CapEx. No, there is no shortage of funds, first of all, and there is no U-turn in taking in completing the projects. So we will complete the projects. CapEx will be as it is, as we decided in the beginning of the year, and that will continue. So all the permissions, statutory requirements, approvals, consent to operate, consent to construction, everything is in place. And our team is working day in, day night. And we are going to spend about 18,000 plus crore rupees in next 2 years, 2.5 years time. And the aim is that we will not be spending more than 6 or 7,000 crore per year. Whatever we earn, we will invest. So our Mr. Naveen Jindal, our chairman, and our entire board has taken a decision that of course we need the banking support always for the opening of letter of credits and getting the limits. But we will be spending only that amount which we can afford to accrue from our existing business, and that is the accruals are going to be somewhere about net PAT will be about 7,000 crore plus. Last year also it was close to 8,000, and last year was 7,000 crore rupees. So if you see the continuously for the last 3 years we are giving the projection 7,000 to 8,000 crores of PAT, which itself shows a very, very solid performance of the company, and we won't be under debt burden once again, and we want to be. So there's no U-turn in the capex. We will continue the capex as it is. There's no problem. The situation, today's situation, what we are seeing, that will I would say, and that will be utilized in the best of the best manner in the interest of our company. Thank you.
Thank you for the detailed answer. My second question actually is a follow-up to the same question. So there has been news flows that you're looking to raise about 15,000 crore by way of debt from several banks. So given the cash flows we are generating, what could be the use of these funds? Are we looking at any large inorganic opportunities that may arise?
I'm not sure what.
So the point here is this 15,000 crore, that is the approval given by the lenders. So, but as I told you that we will be working only on earn and invest policy. But of course, we need the banking system, banking channel, banking support, because you have to open the letter of credit for the imported goods and equipments and also for the domestic one. And that is very much there. So we are not facing any difficulty there in terms of getting the money whenever it is needed. But today we don't need it. Whenever we will need it, the disbursement will be taken.
Sure.
Maybe just to add, I think the 15,000 crore that you're referring to, which may be the term sheet that we would have signed for our expansion project. Yeah, I think that's what we are referring to. But as MD sir mentioned, our objective would be to maintain a very prudent leverage, of between 1 to 1.5 through the cycle. This is of course an approval that we've got for our expansion project. Yeah.
Sure. Thank you very much.
Thank you. The next question is from the line of Ashish Kejriwal from Centrum. Please go ahead.
Yeah, hi. Good evening, everyone. Thanks for the opportunity. So my simple question is on CapEx. We have won already 3 coal blocks. So is it possible to share when can we expect some production from there?
Could you repeat the question, please? Actually, your voice was too loud. May I request you to please speak a little slowly and a little away from the mic?
My question was in terms of capex, which we are doing for operational of our coal blocks. So when can we expect the production from coal blocks coming in, and if possible, if you can guide that in FY23, how much captive thermal coal we can generate from our coal blocks, which we want?
Yes, I'll tell you. We are planning that before 31st of March 2023, we'll be in a position to open at least 1 mine. So we have 4 mines, so one of the 4 mines will be open.
So any volume number which you can give, sir? for FY23?
The clearances are in place. Most of the rehabilitation work is already done, and I think maybe some 50 to 100 crore rupees will be spent for first opening of the mine, and some of the equipment, machinery, and all these things. So I think by March we should open one mine, and not a big amount, maybe 100 crore rupees, not more than that.
So which mine we can open by March?
This will be in Odisha, Utkal.
Okay. Okay. And secondly, sir, this the forex gain which we have reported in this quarter, 446 crore. This is on account of what and in which line item it is mentioned?
Yeah, Mr. Ram Kumar is the line.
This should be on account of the overseas loan that we have, that we have provided to our subsidiary. I think the loan value is close to $1.6 billion. And this FX gain, this is of course unrealized. You have to understand that. It's on account of that.
And this is reported in our top line or raw materials?
Sorry?
In P&L, in which line items these are included here?
This would be under the other expenses line. But we would have called out for this separately so that we have recognized this unrealized gain separately, so we've called it out separately. But you will find it under the other expenses line.
Okay. So, okay. All right. Thank you so much.
Thank you. The next question is from the line of Vikas Singh from Phillip Capital. Please go ahead.
Good evening, sir.
Good evening, please. Go ahead.
Yeah, sir, I just wanted to understand, have we taken any inventory write-downs in this quarter, because after May, the export duty implementation would have bring down the overall value of the inventory significantly?
No, we have not kept anything at hold. We have paid about 113 crores of duty, that is export duty, and we cleared all the inventory of plates and whatever the other products were. And after that, we are working on a very, very structured business, that is making goods, only those goods where we get the value addition, where we can recover major part of the export duty. This is one. The secondly, our first purpose is to meet out the domestic demand, and whatever is not sellable in India, that much of quantity to export. But there are no inventories now.
There are no
Understood.
write-downs, no.
No, so basically this question arises from the other stock adjustment, which was roughly about 1,700 crore. And if I just look at the difference between production and sales, it was just 2.4 million tons. So effectively, that is coming somewhere around 69,000. So was wondering that why this figure is so high on per ton basis.
This may be because of the non-dispatch or non-availability of rakes, but not because of any commercial reasons.
Maybe some of the details you can take it offline with our investor relations team. We are not clear on the question. Maybe you can just take it offline, please.
Understood, sir. And so, sir, just secondly, in terms of our now export strategy, so can you just tell us that now how we see the mix of export going forward? And at present, our export versus domestic realization gap is how much?
You see, I'll tell you very frankly, we are now aiming only for the much more value-added products for exports. And these products are specially tailor-made products, where the customer doesn't mind paying $100, $150 extra, and we recover most of our, duty part. And that is what going on now. And as I told earlier, we will be maintaining our exports 20% plus, because whatever we can sell in India at a price available in India, that is okay. And whatever we cannot sell in India, where we feel that there are no customers for those products, we will export it. We will not reduce our production.
And the price difference, sir, right now?
You see, there are no difference because the price is because it is not apple to apple. Like we are now entering into a very specialized field in Europe, especially for the specialty blooms, specialty plates, specialty beams. Those markets or those products are not sold in India. So these are Europe-specific products. Like we are in pile beams for Hong Kong and Southeast Asia, and also for Mexico. These products are not used in India. So what we have done, it is very difficult to explain technically each and everything, but yes, offline we can. So we are now entering into niche markets where the products are sold in terms of thousands of tons, not in lakhs of tons. And right from Australia to Southeast Asia, Hong Kong, Vietnam, Taiwan, Philippines, and on the west side, it is Mexico, Costa Rica, Guatemala, Suriname, Colombia. These are the markets where, we have the niche markets. And also to United States and Canada. So Canada, for example, we are one of the largest supplier of the specialty beams for the high-rise buildings. So those items are not sellable in India. So we have developed all those sizes where the country-specific requirements are met out. And we have found a great market as a vacuum because all of these products were being supplied by either Ukraine or by Russia. So since they are under war, so we have the opportunity and we are exporting. And we are not compromising on the domestic demand. So whatever our customers they want to buy, so there's our first choice. And wherever we feel that we have surplus capacities available, which we assume contemplates about 20% of the total production will go to exports. And that will be practically evaluated products. We cannot compare those products with the Indian products because in India these products are not sellable. Okay?
Understood, sir. Thank you for elaborated answer and all the best for you.
Thank you.
Thank you. The next question is from the line of Kamlesh Bagwar from Prabhudas Lilladher Limited. Please go ahead.
Yeah, thanks for the opportunity, sir. So one on the part of, like say, the gap between consolidated EBITDA and standalone EBITDA, like say it's around 300 odd crore, and this question is specifically for the CFO. And why such a big gap, like 300 odd crore? Because it has not been there for last 8-12 quarters. So why such a big gap? Why consolidated EBITDA is lesser by 300 odd crore compared to the standalone EBITDA?
Sure. No, this is purely your intercompany transaction eliminations, in compliance with the accounting standards.
Okay. And just harping on the debt numbers. So we would have done roughly around 2,000 odd crore cash profit in this quarter. And on top of that, we had roughly around 3,000 odd crore from the sale of JPL. So cumulative both around 5,000 odd crore. And even if we do a capex of 1,000 crore, which we have not yet quantified, so the debt is down hardly around 1,100 odd crore. So where is the gap on that part? And on the side of working capital, anyways, even in the last quarter we had a huge working capital.
So I think this question came up earlier as well, and as I said, our working capital during the quarter has gone up by around 2,500 to 3,000 crores. And our current objective is to make sure that we are able to realize that working capital during this quarter.
And how much was the capex in this quarter, sir?
Capex was nothing significant, nothing significant. Around 700 odd crores.
Okay, thanks a lot.
Thank you. The next question is from the line of Kirtan Mehta from BOB Capital Markets. Please go ahead.
Thank you, sir, for giving me this opportunity. I have a couple of follow-up questions. First follow-up question is on the project finance term sheet for 15,000 crore that you have signed on the balance sheet of, I think, the Orissa subsidiary. I do understand that you don't have a plan to leverage it, but I wanted to understand the covenants of it what kind of capital expenditure is allowed to be financed under that loan, and also what kind of capital expenditure cannot be financed under that loan because it's a project finance loan. And related to that, the another question was why it has been taken on the books of the subsidiary where the cost of loan would be higher than you would have taken it on the parent. So if you can clarify on these two aspects, it would help.
Sure. Let me try and answer. So first is I think this 15,000 crores is the term sheet is for the project that we are doing, the expansion project that we are doing in Jindalsteel Odisha. Given that this expansion project is happening in Jindalsteel Odisha, the term loan and the term sheets have been taken for that entity. Yeah, I think that would be a simple, straightforward answer for your question.
So basic is that apart from the current capex which has been around for around 18,000 crore, only that can be financed. And if you are planning to add any of the secondary expansions to that project, can that also be financed under the same loan? Because we don't really plan to draw it down either this year or the next. The way I understand it, you plan to actually do it from your own pocket or whatever the cash flow is afforded by the company. So in that scenario, are you aiming to sort of use this project loan for the further capital expenditure that you will be doing after completion of this project, sir?
No. This term loan is for a specific project. The details have been submitted to the bankers and it has been given for this specific project. We cannot use it for any other purpose. As mentioned, our objective is to fund as much of the project through internal accruals and maintain a very healthy gearing. So we cannot use it for any other purposes.
Right. Can you also clarify on the reasons for taking it on a subsidiary balance sheet rather than a parent balance sheet? Because the cost of loan would be higher on the subsidiary balance sheet.
The project is happening in the subsidiary, isn't it? So the loan has been taken in the subsidiary for that purpose.
Right. Second question was about, again, sort of going back to the export mix that MD clarified. I wanted to understand what was the export mix in the FY22. We believe we had exported around 2 million ton of product. Could you give us a breakdown of the category of products that was exported in FY22? And how would this category change in FY23 as per your current plan?
I think I have already answered this. We will be doing about more than 20% of the total produce will go to exports. But I cannot give the breakup that what will be, how much quantity will be beams, channels, angles, or specialty rounds, or the alloy steel rounds, or the plates. So that will be difficult to tell today. But we have made a basket.
Historical breakup at least for FY22, where you have already completed that year.
I can share with you because offhand I will not remember, but I can share with you. I mean, Nishant will share with you.
Sure. One more question, if I can slip in, about the coal project that you are developing. Could you also clarify on the model of development? Are you involving the MDO or are you doing it on your own balance sheet? And does it also involve the complete capex on setting up the mines and all the related equipment, or it's only sort of the payment would go primarily to the MDO operator?
Yes, we will be doing coal mining by ourselves. We have the entire team available. We have been maintaining our coal mines for so many years in Raigarh. And now also the coal mining by our sister company JPL is done by themselves. So we have the expertise available and we'll do it ourselves.
Then in that case, your capex of 18,000 crores would go up by another 1,800 to 2,000 crores for additional capex on the coal mine, because initial 18,000 crore plan did not include the capex on coal mine.
That I think you have to take it differently. First of all, 18,000 crore is for the expansion, the next expansion what we are taking, that includes blast furnace, includes rolling mill, hot strip mill, cold rolling mill, and many more areas. So the coal requirement. So today we are buying coal. So if you see buying coal versus your own coal, so we'll be saving at least 60 to 70% of the input cost or the expenses. So when we save those expenses 60 to 70%, that is the money which is going to be flowed back to the mining. So that is from the existing operations. So the next expansion, what we are seeing, there will be hardly any use of coal in the next expansions. So, but the company which is now running, whether it is Raigad or it is Angul, there we are buying coal from the market, and we are buying coal for what crores of rupees. And the difference will be when your own mines, the difference will be about 60 to 70% of the total cost saving. So there will be no capex impact or no financial impact, because whatever we are saving, and because today we are passing it on to either Coal India or to the importers or to the foreign companies. So that money will go to a development of mine in stages. So hope I answered you.
Right. Thanks for this elaborate answer. Thank you.
Thank you. Ladies and gentlemen, this was the last question for today. I would now like to hand the conference over to Mr. Vishal Chandak for closing comments.
Thanks, Ritija. Thank you everyone for joining for this conference call, and I would once again thank the management for this opportunity. So I would hand over the floor to Nishant for closing remarks. What is?
We'd like to thank both Motilal Oswal, Vishal, as well as the operator. It was and all of you for joining the call. Thanks a lot for your support, as always. Have a great day.
Thank you very much. I share the best, and let us pray to God that all these international geopolitical issues should be resolved as fast as possible to avoid the meltdown of economy worldwide. So let us hope for a good future tomorrow. Thank you.
Thank you, everyone. Thank you.
Thank you. On behalf of Motilal Oswal Financial Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.